Morpho is the open credit network for the world. Simply put, it is a lending primitive layer that allows the creation of immutable and efficient lending markets in a permissionless way. Now, the way to think about it is people with assets can put them on this application to earn interest, and other people can then come and borrow those assets and pay interest. As at the time of recording, Morpho currently holds around $11 billion worth of deposits and close to $4 billion worth of loans. In this video, we'll break down what money markets actually are, how early DeFi protocols like Aave and Compound worked and their limitation, and how Morpho re-architected lending from Morpho optimizers, which was a workaround for Aave and Compound limitation, to Morpho Blue, which introduced permissionless market, and now Morpho Midnight, which introduced fixed term and intent-based lending. And of course, we'll go through the live demo of the Morpho application. By the end, you won't just understand Morpho, you will understand the future of on-chain finance. Let's get right into it. Okay, firstly, we have to understand, money markets and also lending generally. So typically, this is how money markets works, right? We have a lender and we also have a borrower, right? And a lender is anyone who has abundant cash to give out to gain interest. And on the other end, a borrower is anyone who takes this cash for any economic activity and pay interest on it accordingly. Now, in a typical scenario, right, a traditional scenario, a borrower goes to the bank, right? So this is the borrower going to the bank to borrow some money. Then the bank for sure has some money in their reserves to be able to pay the borrower the loan, right? But in any case, the borrower has to put down a security, right? Which in this case stands as a collateral. Now, take for instance, the borrower puts down a house, right? So this house acts as the security, against any default by any chance. And then on top of this setup, the borrower has to pay the sum of, say, 5%, any amount agreed by the bank or given by the bank. And so we have 5% to pay as interest and also the house as collateral, which the bank is going to be selling in the case of default. Now, this is the concept of a collateralized loan. Now, the interesting part about this is that the lender who puts, their money down is getting something around 0.01%, right? This is in the setup of like traditional setting. Now, in the world of decentralized finance, right? Now, this is how, Morpho steps in, right? Morpho becomes the open credit network, which provides, lenders a vault. Now, this is the first part. Morpho provides lenders a vault to deposit their assets, and this vault is mostly put together by curators, which I'm still going to be talking about in a later session, right? And usually, these lenders will pack their assets in this vault based on their risk profiles. And on the other end, borrowers will have to navigate to the market and supply collateral, basically, as we have seen with the case of the bank where, the borrower provided a collateral, right? And in this case, the borrower also provides a collateral over here. Take, for instance, it, right? So one of the things that we can observe here is that in the traditional setup, we have the bank in the picture, but in the decentralized finance and how Morpho approaches it, we do not have banks in the picture. Other than that, right, we have the concept of over collateralization at play. And let me quickly explain that, right? What that means is you have to deposit an asset more than what you are borrowing. Now, in this case, a borrower drops an asset of it, right, as collateral, 1,000. Now, by any chance, if they want to borrow this value, the market sets a loan to value ratio of 75%, right? What that means is that they can borrow $750, right? In this case, right? That's LTV. That's the loan to value ratio. That the amount of collateral is usually higher than the amount to be borrowed. Now, this sort of like helps to mitigate against any form of liquidation and all of those things, right? Now, one other thing is that the interest for borrowers as seen on Morpho market is for some assets or for some markets is 4.63%, and on the other end, the yield is 4.12%. Now, if we compare this to the yield as we have in the traditional setup, it's almost like the decentralized finance provides like a better option. But in any case, you'd ask yourself, why should you do over collateralization, right? One of the reason or the core thesis behind this is that it unlocks capital without you selling it, right? And if I to break that down, that means that you can stay exposed while getting liquidity. And so what that basically means is that you have an asset, take for instance it, and you believe that it is going to go up, right? And you need money for real world activities. What you can do is to, you know, basically take that asset to a lending protocol like Morpho, supply it as collateral, and then borrow against it, and then use the USDC to perform any reward event or activity you want to do while still staying exposed, right? In any case, if it goes up, then you can pay back your your loans, right? Because you would have made profit. Now, the other reason is long and short leverage. Right? What this basically means is also pointing to the same principle, but in this case, once you supply an asset and you borrow against it, what then happens is with the stable coins you borrowed, you buy more it with it, right? And if it goes up, then you make profits. And so the reverse is the case for like short leverage. Another reason is for arbitrage opportunities where you supply an asset, it in this case, you borrow USDC, and then probably found out an arbitrage opportunity on an exchange where they sell it for a lower price, and then you buy with the USDC, and then you sell at a higher price on another exchange. Now, the other reason is for yield farming strategies, right? Yield farming strategies in this case, where like you supply your assets, you get um, USDC. Take for instance, on the borrowed USDC, you are paying 4% on the stable coins, and then there's another yield opportunity somewhere where you can make 15% on depositing that stable coin. Now, when you do that, you can cancel out, the returns on each other. 15% to cancel out, 4%, right? And the last part, which is avoiding taxable events. Now, in some regions, selling your cryptocurrency triggers tax, and one way to go around it is to lock that asset on a lending market as Morpho and then borrow against it, right? And so this is treated as like a borrowed money, right? And which solves the problem of taxation, and it's basically like a workaround. Now, this is the concept of money market and the difference between a typical money market and a decentralized money market, particularly how Morpho approaches it, although we'll still be taking a deeper look into how Morpho changes everything in the coming session. Okay, so now that I've explained money markets and how they work, I quickly want to spotlight, first generation money market, as I used to call them, the need for this type of market, and basically bring us to see the essence of Morpho's contrarian approach later on. First of all, it is worthwhile to mention that in the early days, Earthland existed and brought money markets on chain using peer-to-peer matching system. Now, where a particular borrower sets its terms and a particular lender is being matched to meet those same terms, right? Now, this existed earlier on, but this did not scale because of low liquidity and slow adoption at the time. And hence, protocol like Aave and Compound introduced pool-based lending, right? So this pool-based lending protocol are what I term the first generation money market. Examples like Aave and Compound. And here's how it works. First, as you can see from this image, right, we have the lenders. The lenders deposit assets into, a pool, right? And then the borrowers over here, borrows loan from that pool, and then interest is paid back into the pool, and then, lenders earn their yield proportionally, right? So the major key innovation here is that there is instant liquidity compared to like the early days during its lend, where you have to wait till somebody matches your request, right? And there's no need to find counterparties, and everything is fully on chain. One of the major things to also note is that this type of market add rates. Now, by rate, I mean interest rates. Now, imagine, the suppliers would, or the lenders basically needs to also earn interest rates, and also the borrowers also needs to pay interest rate. Now, all of these things is done based on utilization. Now, utilization in a lending market or a lending protocol is used to measure how available liquidity is being used, right? So utilization is basically saying the total amount of borrowed assets over the total amount of supplied assets. Now let's bring this into perspective. Take for instance, we have $1 million worth of money supplied in a pool, and something like 300,000 worth of that is being borrowed. Now the utilization rate at that point will be 30%. So we have 30% of the liquidity used and 70% idle, right? So utilization tells the protocol if liquidity is scarce or abundant, and this basically determines the price, of borrowing. So now this brings us to the concept of higher utilization equals higher rates, right? Now, how do I mean? It's basically saying that if in a case where we have $1 million supplied and we have 950,000 borrowed, the utilization rate at the point equals 95%, and we have 50K left in the pool. And this might result to say lenders want to withdraw money from the protocol, and of course, there isn't a lot of money in the pool. And this is what leads the protocol to increase the rate at the point. And doing this basically entices, lenders to supply more money and basically to, ensure that the market is liquid, right? And on the other end, this high interest rate sort of like sends away or reduces excessive, borrowing. Now, for lower utilization equals lower rates, the reverse is the case, right? Where we have $1 million supplied and 100K borrowed. This is like 10%. So what then happens is that the rates will become lower. Now, because there is low utilization, we want more people to come borrow, and so hence the rates will be reduced, right? And so this is like the concept as it is. So this pool-based model worked incredibly well, just like I mentioned, compared to like the ETH days, right? There was instant liquidity, no need for counterparty, and things just worked well. But in any case, it has its own limitation, which I'm going to be going over very quickly. Now, the pool-based model has its advantages, but also the limitations, which I'm going to be spotlighting in this session, right? First, the anchor disadvantage is that it is everything about it is protocol defined. And protocol defined, I mean that the protocol defines what type of asset is listed, what type of collateral is accepted, everything around the risk parameters and also liquidation threshold is defined by the protocol. Now, having said that, let's take a look at how this basically, translates into limitation, right? The first part is that markets, are or we are deeply interconnected under one protocol architecture. What this means is that risk management, liquidation, and collateral assumptions are handled at the protocol level, meaning that one issue in a particular market can affect or cascade to the other systems. Now, take for instance, if the protocol accepts a particular asset as a collateral, right, and by any chance that asset becomes really, really volatile, whether due to price or later on in the future, if the token system or tokenomics is being hacked, and then the price goes down drastically. What then happens is that the token crashes first, and then it affects the protocol first because of the sudden crash in the token price, right? The liquidation engine might not be able to catch that, and it leads to bad debt. And every other place where this collateral is being used is being affected, right? So this is like one example of the fact that markets are deeply interconnected under one protocol architecture. And the second part is that governance determines which markets would exist, right? New markets and collateral assets often requires governance proposal or approvals, audits, risk reviews, and also this in themselves slows down experimentation and also market expansion. Now, the other limitation is that it is difficult for a pool-based system to safely support long-tail collateral assets. Now, long-tail collateral assets are assets that has low liquidity or low volume. They are volatile in nature, right? And so doing this, or if this exists in a pool-based system, it's going to increase liquidation risk, insolvency risk, and hence all of this put together makes it harder to support such type of assets. The other limitation is that liquidity becomes siloed across separate pools. Now we'll see this because usually funds are being supplied across many pools, causing some markets to have excess idle liquidity, while others suffer from insufficient borrowing capacity. Now this is also an example of delimitation where like capital is fragmented across each other, across different pools, which leads to like capital inefficiency. Take for instance, we have the ETH pool, we have the DAI pool, we have the USDC pool. USDC pool has over $100 million worth of assets unused, and also on the other hand, DAI has like 50 million. But for it has, take for instance, let's say 5 million, and then a lot of persons wants to borrow it, but because it has 5 million, right, it cannot meet up to that borrowing capacity. And then we have different pool with different assets, right, but then we can't directly take from those pool in themselves, and so this leads to capital being idle, right, and it becomes siloed across separate pools. Now, the last limitation I want to spotlight is that market design was largely or are largely like one size fits all, meaning that interest rate model, risk parameters, and all of those things are or were often like generalized across market, right? Even though different assets required different risk assumptions or like different liquidity, but in any case, the market design was just one size fits all, right? So having said that, right, while Aave and Compound solved liquidity issues in the early days, basically like bringing money markets on chain, right? They didn't fully like solve the market design, and that's where like Morpho comes in. Morpho came up with, I call it the contrarian approach, and we're gonna be taking a look at, the evolution from, Morpho Optimizer to Morpho Blue, and then Morpho Midnight in the next session. Now let's start with the contrarian approach of Morpho and go over them in phases and what each phase solved. Now the first phase is called the Morpho Optimizer, right? So Morpho started by improving the suboptimal rates that existed on first generation money markets like Aave and Compound. Now if you take a look at the historical data of supply versus borrow rates on this first generation market, there's a pain point there for both sides of the market. Take for instance, borrow rates are high compared to like very low supply rates, right? And so Morpho introduced, a P2P matching system. As you can see here, Morpho Optimizer, it has P2P matching engine, the rate optimization, and also liquidity, routing system. Now, this P2P matching system, basically tries to match the lenders directly with the borrowers, right? And so if a match exists, right, then there's a P2P loan match. And so the lenders tend to earn more, right? And then the borrower on the other side also tend to pay the rates within the range, basically optimizing the rates compared to that of the first generation money market, right? And then on the other end, if we do not have a match, right, then it falls back to Aave and Compound. Now, the interesting thing to note here is that, Morpho Optimizer is built on top of Aave and Compound, and as such, it uses like the underlying liquidity on each of these protocols. Now, the key takeaway here is that Morpho built, a liquidity pool optimizer where both the borrowers and the supplier benefits from improved rates while preserving the same guarantees and the same liquidity to counter, suboptimal rates that existed in first generation money market. We can also see, that although this repository has been archived, right, but in any case, we can still go over what Morpho Optimizer is all about. So as you can see here, it improves the capital efficiency of positions on existing lending pools by seamlessly matching users peer-to-peer, right? And basically what Morpho Optimizer did. So moving on, let's go over to the next phase, which is basically Morpho Blue, right? Quick note is that Morpho Optimizer grew to become, the third largest lending platform on Ethereum with over $1 billion in deposited assets. But in any case, Morpho realized something, that operating on top of Compound and Aave to enhance the efficiency of the interest rate model wasn't enough, and that Morpho optimizer's growth is constrained, by the current underlying lending pool, or the lending pool design of Aave and Compound. Hence, there's a need to make a big shift to Morpho Blue, right? Now, Morpho Blue introduced permissionless market creation and permissionless risk management with Oracle agnostic pricing. Now, this basically means that you can, create permissionless and also isolated lending markets, and each of these markets has one collateral, one loan asset, and different risk parameters from the liquidation loan to value ratio, the Oracle, and the interest rate model. Now, you ask the question of what then changes here. What changes is that risk is first isolated, right? Anyone can create a market because it is permissionless. Then interest rates are optimized for both parties, the supplier and also the borrower. Then it is also easier to support long tail collateral assets. So having said that, it is important to know that rates, are still, variable even in this setup, right? But now those rates are now local to each market and not global to the entire protocol. And one of the other cool things introduced in Morpho Blue is that it's externalized risk management, right? As you can see here, there's a second layer in the middle from the supplier. We have the risk expert A, risk expert B, and so on and so forth. And then we now have Morpho Blue. Now, most lenders or suppliers don't go directly picking individual markets themselves, except they are like expert suppliers, right? But then instead, they interact through something called vaults, right? So vaults are like smart asset managers. Instead of you manually choosing which market to supply to which risk parameters to evaluate, you simply just deposit into the vault. As you can see here, the supplier deposits into the vault, right? And then the vault allocates your funds across different markets, right? Now, it brings us to the next interesting part, which is the curators. Now, you ask yourself this question: who decides, where the vault allocates those assets to? That's where curators comes in, right? Curators are risk managers, they are strategy designers. They design which markets are safe and how much goes, or how much capital goes into each of the markets, what's the risk exposure the vault should take, and so on and so forth. Now, with this in place, Morpho Blue offered trustless primitive or infrastructure with increased efficiency and flexibility compared to existing lending platform. Now, that's the whole concept of Morpho Blue. Moving on, we also talk about Morpho Midnight. Morpho Midnight. This is the newest phase of Morpho, the next evolution, and a completely new paradigm for on-chain lending, right? Morpho Midnight isn't just changing how rates are calculated, but it's changing how markets themselves are formed. Now, Morpho Blue itself introduced pool-based open-term variable markets with externalized risk management. Now, with Morpho Midnight, right, it introduces intent-based fixed term, fixed rate markets with externalized risk management and also rate management. In earlier systems, rates are set by formulas based on utilization, just like I mentioned earlier on. It's controlled by the protocol. And so the protocol is essentially the price setter. But with intent-based system or markets like Morpho Midnight, users don't just interact with the pool, they express what they want. For example, a lender says, I want to lend 1 million USDC for 3 months at 8%. Then a borrower says, I want to borrow $500,000 against the it for 90 days. Now, these are intent and not action yet. Now, it is the protocol's job to take those intent and match them and then finally settle them on chain. Now, instead of the protocol deciding rates, what we see is that the market decides the rate. Now, the key insight here is that, liquidity is no longer passively pooled, it is actively offered. So when we combine this intent-based matching system with time-bound commitment, right, we naturally get fixed term lending. And so let's not forget that it is both fixed term and also fixed rate. And here's how it works, right? Borrowers receive funds today, they agree to pay a fixed rate on the borrowed fund, And so no continuous interest and no rate changes, right? This behaves just like zero coupon bond, right? And so this is what Morpho Midnight introduces, a completely new paradigm with new powerful new capabilities like offered liquidity, meaning that users make offers instead of pre-allocating capital in liquidity pools. Secondly, market driven pricing, meaning that the open market sets interest rates and not based on fixed formula. The third capability is that it has flexible loan agreement, meaning that users can include bespoke terms such as long tail collateral, multi collateral, and portfolio as collateral without fragmentation. New capabilities like fixed and variable rates also exist, meaning fixed rate loans and also variable rate vaults are built on top of each other. We also have on-chain compliance, meaning that KYC and whitelisting is done without fragmentation. And lastly, cross-chain compatibility, meaning that it supports seamless offers and settlements across chain. Now, this is Morpho Midnight. Building Morpho Midnight was a reaction to the need from users demanding more bespoke and predictable loan terms, and the sparking interest, of course, from major enterprises and traditional financial institutions. Now, with fixed term lending on Midnight, it unlocks predictable rates, fixed rate, maturity based lending, yield curves on chain, institutional use cases, better treasury management, right? So instead of just liquidity pools, we now move towards the open credit network for the world and on-chain capital market. So in this session, I'm going to be going over the Morpho application very quickly. We'll be exploring the vault and the markets. On the vault, we're going to be lending our assets as a loan asset, for people to be able to borrow on it. And then we'll go to the market and supply collateral and then borrow a particular asset against that collateral, right? So basically, we're going to be exploring what we've been talking about since, especially for Morpho Blue, right? So the first thing we want to do is to ensure that we have assets in our wallet, or you basically have a wallet. So I'll be making use of Rabbit Wallet for this session, and then I want to ensure that I have my assets in my wallet. You can transfer from your centralized exchange to the wallet. And so I've done that, and then I'm going to be using two assets in this session. The first one is the USDC and also CB it, right? So I'm going to be using the Base network for this session, and basically, so I need to convert my ETH to USDC on Base and also Coinbase ETH on Base, right? So having done that on Uniswap, I'll just head over to the vault, right? So now, like we mentioned, the vault is like the interface for lenders to deposit their assets, and then the curator basically allocates these assets into different markets, right? As I explained in the previous session, right? So one of the good thing about Morpho Blue is that it basically externalizes risk management, and this risk management is done by curators. As you can see here, we have different curators from Stickhouse Financials to like Gauntlet to Centora and so on and so forth. And so these curators are the one that curates, the vault, and then they are in charge of allocation, right? Allocating the said assets into various markets. And so as you can see, we have different vaults by different curators, and then the APY also, you can choose whatever vault you want to deposit into or supply your asset into based on like your preference, right? And so for this section, I'm going to be using Stickhouse Prime USDC, and as you can see, it has deposit of over 454 million and it has current liquidity of 140 million, right? And the exposure, meaning that the collateral assets of each market that the vault is lending to, meaning that people are depositing this asset to take the USDC, right? In any case, we have CBBTC, wrapped it, and so on and so forth, right? So I'm going to click on Stickhouse Prime USDC, and then the next thing I want to do is to basically, deposit my assets as a lender. For this one, I'm going to be depositing 10 USDC. You can basically, take a look at the various section. This is the APY, Over the past month, it has been somewhat stable and then it has increased over time and so on and so forth. So because this is variable rate, right, it tends to change over time based on utilization, right? Pretty much, then you can basically just deposit into this and depositing 10 USDC into this vault. I'm gonna sign the transaction and then confirm the transaction, right? So our transaction has been executed, right? So I'm going to navigate over to my position, right? As you can see, it has 10 USDC deposited, right? And I'm expecting a yield of 4.75, right? APY, right? But in any case, that's that about that, right? So you can also sort of like withdraw this and say you want to, you want to withdraw and then click on withdraw, right? And so we first supplied our assets, and then pending the number of time you want to leave your assets in the protocol, right? It gets to earn more yields, right? So now you can also withdraw from that vault, and then you sign, you confirm. So we've successfully withdrawn our position from the vote by any chance, right? Let me refresh this and see what's up. So now let's have a look at my wallet and see. Now I have my USDC back in my wallet, right? And pretty much now the next thing I want to do is to go over to the market. Now in this market we have collateral, right? Now this is the place where people come to supply collateral and then borrow against that collateral. We have CBBTC where you post this CBTC as collateral or wrapped it and so on and so forth. And then this is the rate that you're expected to pay borrowing those assets, right? So pretty much we also have the liquidation loan to value ratio, just like I mentioned, right, in the earlier video, that this type of markets function on over collateralization, meaning that for you to be able to take out assets, you need to drop an asset that is more than what you want to borrow. Now in this case, you are able to, it acts as a security against probably a decrease in price and so on and so forth, right? And that's basically what liquidation loan to value ratio is all about. And so when I post this collateral, I'm able to get this loan asset USDC. And so I have CB and on this particular market, I'm getting 5.22%, right? And so let me supply, say, the maximum amount, and then let's say I want to borrow, let's say $20, right? Pretty much. All right, so what I've been able to do is basically to supply this amount of collateral, and then I was able to borrow against it. If you remember earlier in the video, we talked about the various reasons why you want to do this, right? Or you want to do over collateralization. We talked about getting exposure while still staying liquid, right? Or basically you want to execute some type of long or short leverage or arbitrage opportunities. Now I have this 20 USDC to do whatever thing I want to do, right? And so let me try to refresh this and then head over to my position, right? All right, so this is my position right now, right? This is my position right now, and I've been able to borrow 20%. Now, the liquidation loan to value ratio is 77%, meaning that out of my $40, I'm able to take out 70% of that $40, right? But in any case, I was able to take out 48%. So instead of taking the whole 77%, I took out 48%, which is sort of like still a buffer in case of any form of sudden, decrease in price, right? So that's pretty much about borrowing. If you observe, the process or the step was you supply collateral and then you borrow directly, right? And so let's see my wallet. I should not have like 30, you know, yeah. So I had 10 before, and I was able to borrow 20 USDC, and now I have 30 USDC to go do whatever thing I want to do, right? So now let's try to repay our loan. Um, as you can see, it has like an interest of 5.22, which means uh, there's an interest rate to pay, right, over the period of time. And this is basically being added to your token directly, right? Um, so let's try to repay this. Let me try and repay my maximum amount. As you can see, this is the amount I'm meant to pay. And then I also want to withdraw my collateral altogether. Um, so as you can see, I've successfully, repaid my loan, and then I've been able to, withdraw my collateral. All right, so that's basically all, about, using the vault, right, which is like an interface for lenders to come supply their loan assets into, and then they get their their interest. And on the other hand, for borrowers, all you have to do is head over to the market and then supply collateral and then borrow against it, right? Pretty much what we have been saying all this while on Morpho Blue. And also, once the audit for Morpho Midnight is completed and it's live, we'll also be able to do the raise offers using the intent-based architecture. So that's pretty much it. As we bring this to a close, we've learned money market, the first generation money market, Aave and Compound, Morpho's contrarian approach, and the various evolution from Morpho Optimizer to Morpho Blue, and now Morpho Midnight, and a practical demo on Morpho application. So if you want to go deeper, make sure to check out Morpho Docs, read my full article linked below, and explore the app yourself. Thank you so much for watching, and I'll see you in the next video.